Morning, everyone. Very good morning. How are you all? All good? Well, we are into the live sessions of our CA final advanced capital budgeting in the subject of advanced financial management. We've done quite a few sessions in this subject, and one session in this topic that we had on the last Monday. So we had started with this topic with a brief understanding of what we have covered at CA interlevel. And then we had a roadmap of what all things are we going to cover in this aspect or in this typical chapter of advanced capital budgeting. It was about inflation adjustment, measuring the risk of the capital projects, using the statistical tools, conventional tools, and some other techniques. And then we have the decision tools like the decision tree, simulation, adjusted PV, right? So then we have started already with understanding that if the cash flows are expressed in real terms, that is, if the cash flows are expected at current price levels, then they should be ideally discounted at real rate of return. Whereas if your cash flows are presented in nominal terms, then they should be discounted at nominal rate of return. We also saw the relationship between the real rate, inflation, and the nominal rate. So if we have the real rate and the inflation number, how do we get the nominal rate? If we know what's our nominal rate requirement and the inflation prevailing, we can definitely get the real rate also. Okay. Then we have done two of the questions, question 1 and question number 2, right? Using both, that is real rate of return and nominal rate of return. And one peculiar thing that we came across in our discussion was that when you compute the cash flow after tax, the revenue minus cost into 1 minus T, that's the post-tax revenue minus cost. This is something getting impacted by inflation. But the other part of the cash flow after tax, that is tax saving on depreciation, is not taken care of when we are looking for the inflation adjustment, right? So there's no inflation adjustment required over here. Therefore, we revised our cash flow approach also. Then we have already started with the measuring the risk of a project using expected value, standard deviation, variance, and also the coefficient of variation. So expected value was simply the weighted average of the values that we expect in future. Variance was taking the deviation square rather. Standard deviation was a standardized deviation from the mean, and coefficient of variance was calculated for the purpose of comparison between two projects or two such aspects. Okay. Now it's time for us today to take this capital budgeting tool of statistical analysis to the next level, and then discuss about some more techniques of measuring the risk in a capital project. Okay, so for that case, let me take help of the question number 3 that we have in our assignment sheet. So before that, let us just set a simple rule. If I want expected cash flow, or if we want variance of cash flows, or if we want standard deviation of cash flow, right? So here, when we want the variance or expected value or the standard deviation, we are always going to use the cash flows and the probability. Okay, so use cash flows and probability. Okay, remember, whenever we want to calculate expected cash flow, variance of cash flows, and standard deviation of cash flows, we are going to use cash flows and the respective probabilities to compute it. Same way, if we are required to calculate expected NPV or variance of NPVs or standard deviation of NPV, then of course we are going to use the NPV, rather NPVs, because we'll have multiple NPVs and their probabilities. Okay, so for cash flows, if it is a statistical measure of cash flows, the corresponding probability for that cash flow should be used. Whereas if you're supposed to be calculating the variance of NPV, we should be calculating the expected or standard deviation variance of NPV using the probabilities that are assigned to the NPV. Okay, just keep that particular point in mind. So let's just look at this question number 3 for the time being. This is a case uh, where we are just looking at a single period NPV. That's the expected cash flow just for 1 year. This is a case where we are looking at the cash flows or the NPV, which is applicable for just one of the years. So possible net cash flows for projects A and B at the end of first year, and their probabilities are given below. So for both projects, initial investment is 10,000. Discount rate is 10%. Calculate the expected net present value of the project. State which project is feasible. Now, these cash flows, 8,000, 10,000, 12,000, these are not the cash flows that are occurring at multiple intervals. These are the expected cash flow that we are foreseeing for just the next year. So, in case of project A, we are going to invest 10,000, but the cash flows that we are expecting, it may range from 8,000 till 16,000 with this level of probabilities. And same applies even to the project B. Now we have to decide which project is going to be preferable. Before we decide, we need to have a strong numerical base where we are going to see what is the expected value and what's the standard deviation. So we are basically looking at the risk and the NPV of the project. Okay. So first, remember we have been given the cash flows and their respective probabilities. Right? We have been given cash flows and their respective probabilities. Using this distribution, using this probability distribution, can you tell me what expected value can be arrived at? Using the cash flows and probability, what can the expected value we will be arriving at? Can I say we'll be arriving at expected cash flow of the project after a year, right? We'll be able to get the expected net cash flows, and then we will look for what's the possible the NPV. So first, we are going to get the expected net cash flow. Let me just write this data quickly. We have like probability and cash flow from A. Yeah. So probabilities are 0.1, 0.2, 0.4, again 0.2. So we have 0.1 as the probability, then 0.2, 0.4, 0.2, and 0.1. And the cash flow that is expected from the project A after a year is 8,000, 10,000, 12,000, 14,000, and 16,000. Now, since these probabilities have been given for the project A cash flows, we can get the expected cash flow of this project 1 year later, right? This is cash flow. These are the set of cash flows that we are likely to get from the project in the next 1 year. So we want to know what is the expected cash flow from the project after a year. So for that, we just need to simply multiply the probability with the cash flow, right? So let's multiply the probability with the cash flows. So do the multiplication, which is 0.1 into 8,000, 0.2 into 10,000, 0.4 into 12, 0.2 into 14, and 0.1 into 16. We arrive at this expected cash flows by simply taking the total of these cash flows. So 12,000 is the expected cash flow. So it means the project is pretty simple. We are going to invest today 10,000, but that 10,000 is going to get back to us in the form of a 1 year single cash flow as amounting to 12,000. This is the expected cash flow of project one. So expected cash flow in year one. The expected cash flow in year one, as far as project A is concerned, it is 12,000. Now let me look at what are the possible cash flows and the expected cash flow from project B. When it comes to project B, the probabilities are like 0.1, 0.15, 0.5, 0.15, and then again 0.1. These are the projected probabilities for the cash flows. Now the cash flows over here, range from 24,000, then it's 20,000, then it is 16,000, 12,000, and 8,000. So when we are calculating the expected cash flow from project B, we'll be simply doing the same thing what we have covered, which is probability into the cash flows, right? And then take a sum of all of them. Total. This is what we are getting as expected cash flow from or expected cash flow in year one. So as far as project B is concerned, there the cash flow that we are expecting in the upcoming year is 16,000. Whereas the expected cash flow in case of project A, it is 12,000. Remember, this is not the expected NPV. This is the expected cash flow that we have in the first year. Expected cash flow that we have in the first year. Now, if I want to compute the NPV, of course, the NPV will be also not an exact NPV. Since we are going to take the expected cash flow, what do you think the NPV will be called as? Are we going to call it as 100% sure NPV? No, sir. That is also going to be a expected NPV, right? So when we are looking at expected NPV, we can simply say present value of expected cash flow in year one. So present value of expected cash flow in year one, as far as both the projects are concerned, let me take it the way around. Project A and project B. Expected cash flow. What's the present value of expected cash flow in year one? So for that, let me first write down the expected cash flow in year one. Expected cash flow in year one, it stands as 12,000 for A and 16,000 for B. Then what will be the expected cash flow? We just need to multiply the cash flow with the PV factor. What's the rate of discounting given here, guys? The rate of discounting is 10%. So I'm going to discount this 12,000 and 16,000 using 10%. This is going to be simply expected cash flow multiplied by what's the discounting rate? That's 10%. So when you look at the discounting rate 10%, for 1 year it should be 0.909. Right? So PV factor 0.909. So this multiplied by 0.909 we get the present value of expected cash flows in year one. Of course, this is a cash inflow, and we need to know, what's the net present value. So if you want to see the net present value, you simply subtract the investment of 10,000, right? In both cases, the investment is 10,000. So we can say expected NPV. Expected NPV is, in the first case, 908, and in the second case, that's 4544. Now, undoubtedly, can you say which of the projects should be accepted? Can you tell me which of the projects should be accepted? Should it be project A or should it be project B? Should it be project A or project B? Yeah, guys, tell me. Project A or B? Project B, because it has got a higher NPV number, right? Okay. So I hope this is pretty clear. Simple question to understand the very simple concept of expected NPV. Are we all good, guys? Yes. Perfect. So we are done with this question number 3, which was looking for calculation of expected NPV by simply taking the expected cash flow in year one and then you discount it to the current level. Now, let's take it a bit ahead. Now, this sort of cash flows that we observed, this was actually having cash flow for just one of the years. Right? This was just having a cash flow or the probability distribution for only 1 year cash flow. It is quite possible that we may have cash flows which are ranging over multiple years, right? So over multiple years, you can say the cash flows may be uh, varying. Like in the first year, we may have a range of cash flows. In the second year, we may have a range of cash flows. Then we need to decide how do we get the expected NPV in such situation. So to address that, let's look at question number 4. Look at question number 4, guys. Let's look at question number 4, guys. So what's the difference in question 4 as compared to question number 3? We have the cash flows for year 1, separate cash flows for year 1, year 2, and year 3, right? So the range of cash flows is varying over a period of years. And again, we have to get the expected NPV of the project using 10% discounting rate, which is pretty simple. We are master at it to get the PV factor and then taking the present values, right? So in this case, we need to first get the expected cash flow for each of the years. Like we need to get the expected cash flow for year 1, for year 2, or year 3, and then simply take the NPV calculation. Okay. So let's just try to do this question number 4. Yep. So we have the data with regards to year 1, 2, and 3. We just have a really nice format. Yeah. 3 years. So this is calculation for year 1. This is going to be the calculation for year 2. And this one is going to be for year 3. Okay. So for each of these cases, what we are going to look at is the probability numbers, right? Then the cash flows, and then finally probability multiplied by cash flow. Okay, so we are calculating cash flow for each of the respective years. Okay. Now, let's take down the data quickly. Probabilities that we have is 0.1, 0.2, 0.3, and 0.4, right? And then if you look at the cash flows for year one, that's already given to us. Year one cash flows are 2,000, 4,000, 6,000, and 8,000. Same way, let me write down the cash flows that we have in year two, which is probability of 0.2, 0.3, 0.4, and 0.1, with the cash flows as 2,000, 4,000, 6,000, and 8,000. Same way, we have the cash flows for year three with the respective probabilities. So that's 0.3, 0.4, 0.2, and 0.1. Then the cash flows are 2,000, 4,000, 6,000, and 8,000. So if you observe, there is a peculiarity in this set of cash flows. Do you observe any peculiarity, any sort of observation about your about the cash flows, guys? Any sort of observations in the cash flows? Can I say all the cash flows are same, like 2,000, 4,000, 6,000, 8,000? Correct? All the cash flows are same, but what is different across the years is the probability, right? So in the first year, you'll find that probability is assigned, more towards the, uh, higher end, because you can actually foresee the near future better than the far future. So in year one, we are assigning like, 40% probability to 8,000 cash flow. And then you have a higher probability for the mid cash flows. And then as you go far, you are being very conservative. And you know what, you're assigning more probability to the lesser amount of cash flows, right? So let's look at the calculation of expected cash flow. Now, expected cash flow can be computed on the similar lines, what we have been doing. So that's going to be like 0.1 multiplied by the cash flows. So simply take the total of the summation of the product of the cash flows and the probability. Then we do the same thing for year two, and then also for the year three. And then for each of these years, what we do is we simply take a summation, right? And get the expected cash flow for each of the 3 years. So since we had the probability numbers, we got the expected cash flow for each of the years. Now it's time for us to calculate the NPV. Now that can be simply done in a pretty easy manner. We can say calculation of NPV. So calculation of NPV involves like here, I cannot say the word cash flow. I will say expected cash flow. In fact, we are not here to calculate the NPV also. We are calculating essentially the expected NPV. We write down here expected cash flows, the present value factor, and then we take the PV. So we have like year zero. We are going to invest. How much, guys? What is the amount of investment that we have? Investment is 10,000, right? The initial cash flow or expected for cash flow in year zero, that's going to be 10,000. Then the cash flow in year 1, 2, 3 is going to be the same as what we have derived, 6,000, 4,800, and 4,200. Then we write down the present value factors. Now, present value factor will be calculated using a cost of capital of 10%. Right? Since our cost of capital is 10%, I need to get the present value factor. So we'll say 1 divided by 1.1 to the power of number of years. we get the present value factors, right? And then PV, which is expected cash flow, into PV factor. And then when we are looking at the NPV, that will be just summation of these aspects, which is 2577. This 2577 is nothing but expected NPV of the project. 2577 is the expected NPV of the project, considering the future probabilities and the cash inflows and outflow pattern. Is it clear? Very simple, guys. Correct? Simple? Yep. Perfect. So we have done expected NPV for a single year, expected NPV for multiple years. Now it's time for us to get involved into the probabilities, right? Let's get involved into the probabilities with the risk measurement. So probabilities along with the risk measurement using the variance and standard deviation. So for that, we'll take help of the question number 5. We'll take help of question number 5 because the question 5 asks us to calculate the variance and the standard deviation of project A and B on the basis of following information. Now, can you tell me, in this question, will we be able to calculate the standard deviation of the NPV or standard deviation of cash flows? Tell me, guys, from this question 5 data set, what can you say? Will we be able to calculate the standard deviation of NPV or standard deviation of the cash flow? Standard deviation of NPV or standard deviation of cash flows? Standard deviation of cash flows, because we have been given the set of cash flows with their probabilities. Remember, I told you at the very start of our today's session that we are going to calculate the cash flow, variance of cash flow, standard deviation of cash flow when we have the probability and the cash flows, right? And here again, NPV will be computed. Expected NPV, expected variance or standard deviation of NPV if you have the NPV data. In this question number 5, what we find is we are having the cash flows with their respective probabilities, right? So we will be able to calculate the variance and standard deviation of the cash flows and not of the NPV. Moreover, sir, we cannot calculate the NPV because when you have cash flows, you need the discount rate, right? You need the discount rate. So let's try to solve it together, guys. Yeah. Let's try to solve it together one by one. Yeah. So let me just take this data. This is our question number 5. Yeah. So project A and project B, we want to compute the variance and the standard deviation, guys. So let me do it for project A, and then I'll just give you maybe 3 minutes time to you to solve project B numbers. Okay, can we do it? Yeah, guys, I'll solve project A. Project B, you are going to do it with a timer set 3 minutes, not more than that. Okay, let's quickly do it. Project A, we've got for project A, we have like year, no, not year. It is probability, right? Probability, and we have the cash flows. Okay. Now, when we are computing the standard deviation or variance, if you can recall the formula that we had, variance was essentially summation of P into probability into X minus X bar square. X bar was our expected value. So first we need to get the expected value here. So probabilities are given to us. Probability is 0.1, 0.2, 0.4, 0.2, and 0.1, right? Then based on this, we have the cash flows as 8,000, 10,000, 12,000, 14,000, and 16,000. These are the cash flows. Now, what we need to do is we need to first get the variance of expected cash flow. Variance of expected cash flow. So for that, we need to first get the expected cash flow. Expected cash flow. Expected cash flow will be simply obtained at probability multiplied by cash flow. Simply probability multiplied by the cash flows, right? And then we take a summation of it. So summation of probability into cash flows. That's 12,000, right? Summation of probability into cash flows. That's 12,000. That's the expected cash flows that we have already got, guys. Now we are looking at calculating the variance and the standard deviation. Now, what was the formula for variance? Formula for variance was, you can recall, it was summation of probability into, this is going to be cash flows minus expected cash flows right? Probability into cash flows minus expected cash flows square. We have already learned the logic for this in the previous class, guys. Right? So what we need is essentially cash flow minus expected cash flow as one of the column. We will say cash flow minus expected cash flows, right? And then we say it should be the cash flow minus expected cash flow square. So let's first do the subtraction, which is cash flow minus 12,000, right? So this is the cash flows minus expected cash flow number. Next, what we do is we're just going to take a square of it and then multiply it with probability, right? And simply say you can take a square of this, which is 4,000 square minus 4,000 square, and then we multiply it with the probability term. Take a total of all these numbers. What we did is first we took the difference between the expected cash flow and the real cash flow, and then we took a square of it, the square of the expected cash flow, a square of the deviation rather, and then multiplied it with the probability. Okay, so we had 48 lakh as this particular number. Now, expected cash flow was 12,000. If you want to take the variance of it, this is nothing but this 48 lakh is the variance. But we know 48 lakh variance is a very much magnified variance. So we don't want that particular number to be variance as a measure of risk. So what we calculate is standard deviation. Standard deviation of expected cash flow. So that's nothing but square root of variance, right? That's nothing but square root of variance. So I just take the square root of 48 lakh. The square root of 48 lakh is nothing but 2190.89, right? Okay, so here we have this particular standard deviation, right? So 48,000. or 48 lakh and 2190 is a standard deviation. Now it's time for you to solve the question number 2. Okay, can we do it? Question number 2, guys. Can the standard deviation be in percentage form? No, Sumit. In this case, since we are calculating the standard deviation of expected cash flows, so standard deviation is also going to be in rupee terms. But yes, when you want to compute uh, coefficient of variation, when you want to compute coefficient of variation, then you can say it will be in percentage form, because coefficient of variation will be, standard deviation divided by the expected cash flows. The standard deviation divided by expected cash flows. There, what you do is simply divide the standard deviation with the cash flows. And now here you can say this is okay, percentage terms 18.26. But standard deviation will be having the same unit as your subject is, as your data is. Okay. Sure. So project B, guys, quickly solve it. Let me just put up a timer. Try to solve project B, guys. Get me the expected cash flow and also give me the what do you say, variance. Let me just get the timer installed. Yeah, come on, guys, quick. You can just scribble around quickly just to check the calculation part. You not write it fully with your proper handwriting. You can just quickly solve project B and give me the values of expected cash flow and the variance along with the standard deviation. Project B. Quickly solve it, guys. Okay, expected cash flow is 16,000, everyone. Perfect.
Jagbanduji, there is a query in a query portal. Just check it.
Yeah, I just checked it, sir. They're asking us to time to solve the question. So I just gave them this time quickly so that they can try out this question. Okay, so I can see expected cash flow is already arrived at, and one of you have also got the variance. Okay, I'll not disclose the variance now. Let the students try quickly. 415. Okay, good.
Jagbanduji, another query has come from Homa Parveen.
Yeah, I can see now. Uma Parveen, could you please explain once more why not to calculate coefficient of variance? We have calculated. I mean, the question is not asking for coefficient of variation. Okay, if the question asks us, definitely we need to do it. But earlier, why did I calculate coefficient of variance in this question is because there was a query from one of our students that whether we should be having that as, whether we can express this as a percentage term, standard deviation. So I simply explained that standard deviation has to be of the same unit which the cash flows are. So as the cash flows are expressed in rupee terms, your standard deviation is also going to be in rupee terms. But if you want a relative measure, you should always look for the coefficient of variance. Okay, so coefficient of variance in our previous class also I've explained that that's useful when you're going to compare the projects. So when you're looking for comparison between two different projects, there, of course, the pattern of cash flows, the extent of investment and the size of cash flows that you receive, that is different. So to compare for the comparison purpose, you get a relative term, which is in percentage terms, right? But here we are just calculating the NPV and the expected value, the standard deviation and the expected cash flows. And therefore, the question itself doesn't require us. And hence we are stopping ourselves at 2190. If the question would have asked for standard deviation, coefficient of variation, then we would have considered the same, because we just need to get the variance and standard deviation here. Okay. Okay, so I've got the answers. Expected cash flow is 16,000. Okay. Let me just quickly verify your claims, guys. So for project B, the cash flows are a bit different. I just need to change the data to get the answer, guys. So just, yeah, so probabilities are 0.1, and then we have 0.15, 0.50, 0.15, and 0.10. Cash flows are like 24,000, 20,000, 16,000, 12,000, and 8,000. So we get the expected as 16,000, and variance term is going to be calculated as 17 lakh, or sorry, 1 crore 76 lakh. That's the variance. And standard deviation, variance is this. We know standard deviation is going to be simply square root of this term, which is 4195. 4195.23. I can see many of the students have got the same answer. Yeah, almost all of you have got it. No. Standard deviation is, variance is 2 lakh. I think Vigneshwar Mamta has solved it in somewhat incorrect way. Okay, the otherwise variance is, okay, we should consider project A as its standard deviation is less than project B. Well, the decision I cannot take it here, guys, because this is not on the basis of NPV. First up, we are looking at the cash flows, right? Now here, if you look at the expected cash flow, there we have an expected cash flow of 12,000. The expected cash flow in project B is 16,000. So as far as expected cash flows are concerned, project B is having a higher number. When it comes to standard deviation, here it is 2190, then here it is 4195. Of course, standard deviation we cannot compare. We need to get the coefficient of variation. Right? So let me get the coefficient of variation. This is going to be standard deviation divided by the expected value or expected mean, which is working out to be 26.22%. Right? So now you only guys tell me if I'm comparing both risk and the expected value. Here 26.22 means that for your cash flow of 16,000, 26.22 is subject to variability. So as the coefficient of variation is lower, the risk per unit of the return is going to be lower, and project A is obviously less risky, and it is also going to provide you lesser amount of cash flow. Project B is, of course, having a bit of higher risk, and of course, the expected cash flow is also higher. Okay, so what conclusion we got? Yes, coefficient of variation wise, project A is taking a lead because risk and expected cash flow, when we compare both of them, project A is a better choice. Right, so lower coefficient of variation is definitely preferred, guys. Okay. Okay. Now let's proceed with the next aspect. um, we'll do one of the questions, which is again with regards to the probability, just one question, and then, yeah, question number, I'm just giving you a few questions as homework, guys. You can look at this questions, which are very similar to what we have done, right? Let's try to solve this. Yeah, question number 13, we'll solve it now. I'll give you a few questions later as homework also. Skylark Airways is planning to acquire a light commercial aircraft for flying class clients at an investment of 50 lakh. So here the investment involved is 50 lakh. So over a period of 3 years, we have the CFAT and the probability numbers. Then the company wishes to take into consideration all possible risk factors relating to airline operations. The company wants to know expected NPV of this venture, assuming independent probability distribution with 6% risk-free rate of interest, the possible deviation in the expected value. How would the standard deviation of the present value distribution help in capital budgeting decision? Okay, so yeah, so this question involves not only calculating the expected NPV, but also we want to know the value of the possible deviation or the standard deviation number. We also need to get the expected cash flows, and then, of course, we are going to calculate the standard deviation also. Now, let's get started with this question, guys, with this data. First up, so this is question number 13 that we are doing. We have probabilities and CFAT for each of the respective years. And, we wish to know what is the possible expected NPV. So to calculate the expected NPV, again, we'll have a setup like this. Okay. Now, year one, the probabilities are like 0.1. Then we have 0.2, this 0.4, 0.3. And for each of these year one, we have the cash flow after tax available. Let me take everything in terms of in lakhs. Let's calculate all the values in lakhs. Okay. So that we are not, getting ourselves involved in too much of numerical numbers. You can simply take everything in terms of lakhs. So cash flows are 14 lakhs, 18 lakhs, 25, and 40 lakhs. So we have the numbers as probability multiplied by cash flows, right? So taking a summation of this 27, can I say this is the expected cash flow in year one? We are expecting a cash flow of 27 lakhs in year one. Same way, we can get it for year two also. So for year two, it is 0.1, 0.3, 0.4, and 0.2. And the cash flows are 15, 20, 32, 45. So again, we do the same thing, probability multiplied by cash flows, right? Then take a total, 29.3, 27, and 29.3 is the expected cash flow in year two. In the third year, the expected cash flows can be obtained on a similar line by assigning the probabilities 0.2, 0.5, 0.2, and 0.1. And then we take down the cash flows as 18, 25, 35, 48, and then multiply the probability with the respective cash flows. So this is total 27.9. So you have got the expected cash flows for each of the year. Now we can definitely get the NPV by simply write down the year, the cash flows, and of course the PV factor and the present value. So year 0, 1, 2, 3, 4. So 4 in the respective, no, it's 3 years, sorry. So for the 3 years, we have the cash flows as initial year. There is an investment in the light commercial aircraft of 50 lakhs. We say that's minus 50. In the first year, you're expecting a cash inflow of 27. In the second year, you're expecting a cash flow of 29.3. And the third year, you're expecting a cash flow of 27.9. Now, PV factor, the question asks us to calculate the NPV with a risk-free rate. So let's get the PV factors as 1 divided by 1.06 to the power of number of years. Right. So these are our present value factors. Then we have the PV as cash flow multiplied by present value factor. Right. We get the present value. And when we want to get the NPV, we can simply take a summation of this. So the expected NPV of the project is 24.97. So it is pretty simple. Whatever we have done in the previous previous questions is just the same thing, right? Okay. So now the next aspect the question asks us is the possible deviation in the expected value. The possible deviation that we are looking for in the expected value. Now, we can get the deviation in the expected value. We are not asking the deviation in the expected, the expected NPV. But right now, we need to first get the deviation that we are likely to get in the expected value. So I need to get the standard deviation and the variance for year 1, year 2, and year 3 separately. Okay, I need to get the standard deviation for the cash flows in year 1, standard deviation for the cash flows in year 2, and standard deviation for the cash flows in year 3. And then we will also compute what is the expected standard deviation in the project NPV for the entire 3 years. So first we need to get the deviation possible in the year 1, 2, and 3. So let's first compute calculation of standard deviation in cash flows. Okay, so when we're looking at calculation of standard deviation in cash flows, of course, I need to get it for the years separately. So let me do it for first year 1. So in the year 1, we need to have the probabilities and the cash flows. Then what we are essentially going to do is cash flow minus the expected cash flow. Okay. And then we do the probability multiplied with cash flow minus expected cash flow square. Right. So this same set we are going to have in all the respective years. So let me take down the probability and the cash flows available. So what we need is cash flow minus expected cash flow. So we have this cash flow minus what was the expected cash flow in year 1? It was 27. Right. So expected cash flow was 27. So we simply took a deviation. This is like minus 27. So these are the deviations that we are observing in year one, then what we do is we take a square of this term, right? And then multiply this with probability, right? So dragging it down, we can get the sum of it. Now, this is simply summation of the probability into the deviation square, right? Can you tell me what is this measure? What can I call this 85.4 as? Can anyone tell me what can we call this 85.4 as? Can I call this as standard deviation or can I call it as variance? 85.4. It is variance, right? Yeah. So variance of cash flows in year one. In year one, we have this variance of cash flow. Okay. Now, if I ask you, what's the standard deviation of cash flows in year one? How can we get the standard deviation of cash flows in year one? Can I say it will be just square root of this number, right? 9.24. Correct. Now, same way, we can get this calculations for year 2 and 3. So for year 2, we write down again the probabilities and the cash flows. So probabilities are like 0.1, 15, 20. Okay. Let me just take down these numbers for year 2. And now again, we are going to subtract the expected value, which is 29.3. And this 98.61 is the variance for the cash flows in year 2, and 9.93, that's the standard deviation in year 1. Okay. Same way, we can get it for year 3 also. Let me simply get it for year 3 also. So year 3, we can calculate the standard deviation and variance by simply substituting the values. Nothing great in this. We're just going to use this probability and cash flows to arrive at the standard deviation and the variance. Here the expected value is 27.9, right? So that's what we are getting this. Yeah. So now here we have the variance for the year 3 as 74.29 and standard deviation of cash flows in year 1 as 8.62. Okay. Now we are interested. We have already calculated the variance and the standard deviation for each of the respective years' cash flows. But you know what our area of concern or discussion right now is? We essentially want to know what is the standard deviation of the entire project. What is the standard deviation of the entire project? So for that, I need to take account of standard deviation that is happening all across the years. So remember, when we are calculating standard deviation about the project, the calculation will be like, first we will get the variance of the NPV, right? Because our expected NPV is 24.97. But are we sure that NPV will be 24.97? No, sir. It is subject to fluctuation. How much it can fluctuate? So that's what we are going to get the variance of NPV. Variance of NPV is simply calculated as variance of cash flows in year 1 divided by 1 plus the rate, plus variance of cash flows in year 2 divided by 1 plus R square, because we need to uh, sort of discount it. But wait, since it is a variance term, since it is a square term, remember this particular aspect, variance of cash flow in year 1, this is a square term, right? This is a magnified variance. This is a magnified deviation, right, guys? I hope remember that variance is a magnified variant. Variance is a magnified deviation, correct? So I cannot, divide it by 1 plus R. Rather, I'll need to divide this with again a magnified discounting factor, which is nothing but 1 plus R square, right? And this side, for the second year also, we are going to again give it a magnification effect by not considering the power as 2, but the power as 2 raised to 2. Right? So let me just tell you like this, that this is of course raised to 1. Okay, this is 1 plus R raised to 1. This is of course 1 plus R raised to 2. And the variance of cash flow in year 3 will be of course divided by 1 plus R raised to 3. But wait, we need to give the effect of the magnification in it, because our variance is a magnified term. It's a square term. So even my discounting factors should be, squared terms. So we are going to have a square of this. Why are we doing this squaring? Why are we doing this squaring? Because we are looking at the variance, which is already a squared deviation, right? So since this is a squared deviation, even in the denominator, when we are discounting, we need to take the squared present value. So essentially, this becomes, variance of cash flow in year 1 divided by 1 plus R square, plus variance of cash flow in year 2 divided by 1 plus R raised to 4, plus variance of cash flow in year 3 divided by 1 plus R raised to 6. So this raised to 2, 4, 6 is happening because of the magnification that we have in the numerator. Okay. So essentially, when we are calculating the NPV over here, it's going to be like 85.4, then 98.61, and then it is 74.29. Of course, all of them are going to get added. Right? And then I need to divide it by what percentage, sir? 1.06. This will be to the power of 2. Right? So this is going to be 1.06 to the power of 2. Then the next number will be, of course, 1.06 to the power of 4. And here it is going to be 1.06 to the power of 6. This is something new that we are learning, right? So this number essentially comes out to 85.4 divided by 1.06 to the power of 2. Then the second term will be 98.61 divided by 1.06 to the power of 4. And this is 74.21 divided by 1.06 to the power of 6. When we add all of them together, we get 206.4856. This is the variance of NPV. The variance of NPV. Now, if I want the standard deviation of NPV, we want the standard deviation of NPV. You know what's going to be the standard deviation? It's going to be simply the square root of 206. Right? So 14.37 is the standard deviation for the NPV. right? Now, one question may arise, sir, why do we need to really compute the variance first and then the standard deviation? Why should we really compute the variance and then the standard deviation? Because it's a statistical rule, guys. Now, as of now, I cannot go deep delve into the statistics, but all the properties that are applicable for manipulation of data to modify your standard deviation, that cannot be done. You need to first get the variance number and then you can get the standard deviation. Because the idea is when we were calculating also the variance, you found that if you just took the variance, just that is just the deviation between the numbers, we got the expected deviation to be zero, right? But that's not the case. So first we need to square it and then take the square root to arrive at an appropriate number. So that's a statistical convention or a statistical rule which we need to follow. Okay. So Karthik, think I have answered your query. You were asking, can we apply just normal rate on standard deviation respective year and the result of which is standard deviation of NPV, and we can square it for variance? No. As I said, it's a statistical rule, guys. You need to get first the variance value and then take the square root to get the standard deviation. Have I answered your query, Karthik? Yeah, correct. Okay. If someone is also asking query, uh, in year three, power should be 8. No, because in year three, what we did is 1 plus rate to the power of 3, general power 3, but we need to square it. So 3 into 2, that's going to be 6. Why to do the same way of calculation when we have already multiplied cash flow with probability while calculating expected cash flow? We have calculated the expected cash flow. We have calculated the standard deviation of year 1, 2, and 3 cash flows. But what we want is the standard deviation of the entire project or standard deviation of the NPV. Okay. So to take that into account, when we want to compute the standard deviation of the entire project, I need to take consideration of standard deviation that is possible in each of the years, in each of the respective years. Okay. Now, mm, question number 14, guys. Yes, Sumit. For the entire project standard deviation calculation, variance has to be taken. Correct. Question 14. A company is considering project X and Y when the following information, the expected NPV and standard deviation is given. Which project would you recommend based on the above data? Explain whether, in your opinion, will change if you use coefficient of variation. Which measure is more appropriate in this situation and why? Calculate the coefficient of variation, guys. My PC is asking why NPV is used in variance as we have deducted any investment. As we have deducted any investment. Yeah, so that's NPV. Okay, so this is not of the variance, we can say variance of the project, you can say. Okay, because we have not calculated the NPV as such. So you can say this is the variance or standard deviation of the project for the entire life. Okay, question number 14, guys. Tell me what should be the recommendation from the above data out of project X and Y. Which one are we going to choose? X is having an expected NPV of 1,22,000 with a standard deviation of 90. Y is having an expected NPV of 2,25,000 with a standard deviation of 1,20,000. So based on only expected NPV, which project are we likely to choose? Based on only expected NPV, which project are we likely to choose? Only expected NPV. Based on only expected NPV, we are likely to choose which project? Of course, Y. Okay, but if we are looking for standard deviation on the basis of standard deviation, because we are looking at risk aspect, only risk perspective, which project are we going to choose if we are considering the risk, if we are considering the standard deviation? Project X or project Y? Based on only standard deviation, which project are we going to choose? Project X or project Y? Of course, project X, because the standard deviation appears to be low. But when we have such a situation where, NPV is higher, standard deviation is higher, so we're going for low standard deviation project, it's not actually appropriate to select the project on the basis of only NPV or standard deviation. The more appropriate way is to calculate coefficient of variation. Now tell me, what will be the coefficient of variation in case of project X? Can you tell me what's the coefficient of variation in case of project X? It's going to be 90,000 divided by 1,22,000. So 90 divided by 1,22,000 is how much? So 90 divided by 1,22,000, that is 73.77%, or I can say 0.73. So that's 73.77%. What about project Y? 1,20,000 divided by 2,25,000. That's 0.533 or 53.33%. So tell me, based on coefficient of variation, which one are we going to choose? Of course, it's going to be project Y because it's having a lesser coefficient of variation. Or lesser coefficient of variation means risk per unit of NPV is lesser in case of risk per unit of NPV is lesser in case of project Y, right? So if you look at standard deviation, project X is preferred. If you look at coefficient of variation, project Y is preferred. Which measure is more appropriate in this situation and why? Because looking at only standard deviation, project X is something giving you a better risk way, and coefficient of variation, which is risk per unit of NPV, that is lower for Y. So which project or which method should we be really using? Which measure is more appropriate? Yeah, which measure is more appropriate, guys? Which measure is more appropriate? Well, over here, the more appropriate way is to look at the expected NPV, because expected NPV is nothing but the likely increase in the wealth of the investment. With your objective of wealth maximization and also taking into account the coefficient of variance, we can say that project Y should be chosen because it will lead to wealth maximization, and also the risk per unit of NPV is also lower. Okay, are we good, guys? Okay. Now, this question number 15, I'm giving you it as homework, guys. You have to try it on your own. Question number 15 is homework for you. Okay. Then 16th, we'll do it later. Now, yeah, let's do this question number 16 now. It's again a new type of question, question 16. Quickly go through the question, try to understand it. Just half a minute time for you to go through the question, try to understand what information is given in the question and how do we go about discussing it. From where will you get the solution for homework questions? You can first you solve it and bring it. In next class, I'll tell you where you will get it. Okay. Question 16, guys. Please go through it. Yeah. So we are following are the estimates of the net cash flows and probability of a new project of Mrs. X Limited. So we are going to make an investment of 4 lakh in the project. Estimated net after tax cash inflows per year is 1 to 5. So years 1 to 5, we are going to get a possible cash flow of 1 lakh or 1 lakh 10 or 1 lakh 20,000 in the respective years, and the salvage value that we are expecting. So we are like putting up 3 probabilities. First scenario is 30% chance, where you are expecting a net cash inflow of 1 lakh or 1 lakh 10 or 1 lakh 20, depending on the scenario and the probability, and the expected salvage is given. Required rate of return from the project is 10 years. 10%. Find the expected NPV of the project, then the best case and the worst case NPV, then the probability of occurrence of worst case if cash flows are perfectly dependent over time and independent over time, then standard deviation and coefficient of variation, assuming that there are only 3 streams of cash flows which are represented by each column, coefficient of variation for on its average project, which is in the range of 0.95 to 1. So this is the last part, which we'll do it later. Now, first we need to focus on what's the expected NPV of the project. So let me get started. Question number 16. Okay, so question 16, we have an initial investment. Now we want the expected NPV of the project. Expected NPV of the project. So for that, I need to get the first the expected cash flows for each of the years. Rather, expected cash flow for each of the cash flow streams. Let me write down the year. Then we'll have some sort of calculation. We'll say net cash flows. We'll write down the PV factor, and then the present value. Year 0, there is no doubt that we are going to make an investment of 4 lakh, because that's the same thing for each of the respective years. So it's going to be minus 4 lakh. Then from year 1 to 4, we are going to have cash flows which are expected, which are having a probability distribution. So probability distribution is like 1 lakh is having a probability of 0.3, 1 lakh 10 is having a probability of 0.5, and 1 lakh 20 is having a probability of 0.2. So I need to give that I need to take that into consideration. So we'll say 1 lakh into 0.3 plus 1 lakh 10,000 multiplied by 0.5 plus 1 lakh 20,000 multiplied by 0.2. Right? So we are simply calculating the expected cash flows. Now, if you solve this, this works out to be 1 lakh into 0.3 plus 1 lakh 10,000 into 0.5 plus 1 lakh 20,000 into 0.2, which is 1 lakh 9,000. And then in the 5th year, there is going to be a salvage value. Again, the salvage value is likely to be varying because salvage value may range, from 20,000 till 60,000. So let us say salvage is 20,000 into 0.3 plus 50,000 into 0.5 plus salvage is 60,000. So 60,000 into 0.2. Okay. So this will work out to be 20,000 into 0.3 plus 50,000 into 0.5 plus 60,000 into 0.2. That's 43,000 expected cash flows. Now we just apply the PV factors. Sorry, this is going to be till year 5. Okay. So PV factor, of course, for the first year it is 1. Now the rate of discounting is to be taken as 10%. So when it comes to 10%, the present value annuity factor for 5 years is going to be 3.1. Yes. Okay. This is 3.791. That's the present value factor. 5th year, PV factor will be just 0.621. Multiply the cash flows with the PV factors and then take the sum of it. Okay, so we got 39,922 as the expected NPV of project. Expected NPV of the project is 39,922. Okay. Fine. So that's expected NPV of project is done, 39,922. Now the next part of question is, what is the best case and the worst case NPV? Now what do we mean by the best case and worst case? Best case NPV and the worst case NPV. Best case NPV and the worst case NPV. Now, worst case NPV is, you're getting a cash flow of only 1 lakh for the, next 3 years. The worst situation, in the worst possible situation, we say that your entire cash flows in the subsequent years, in the future years, are going to be the lowest possible number. And the best case will be, you'll be receiving the highest amount of cash flows possible in the subsequent years. Okay, so best case NPV best case is when future cash flows are the highest possible cash flows each year. So can I say, in case of best case NPV, the future cash flows that you're going to be receiving will be the highest number, which is 1,20,000 of recurring cash flows and 60,000 as salvage value, right? So we can say from year 1 to 4, this is going to be 1,20,000. And in year 4, this is going to be 60,000. So if this is the case, we say here cash flows. Of course, zeroth year, it is going to be 1 to 5 and year 5. Zeroth year, it is going to be a simple, the same cash flow because there's no variation in the zeroth year because initial investment is remaining still as 4 lakh. Your initial investment is 4 lakh. But when you're looking at best case, you're looking at the highest possible cash flows each year, right? So in that case, you just need to take the present value factor and take the PV. Present value factor is what we have already got. There's 3.791. and 0.621. So present value will be cash flows multiplied by PV factor, and then we take a sum of this entire expression. The best possible, we can say NPV is 92,180. That's the best possible cash flow which we can get. Now, if we are talking for the worst case NPV, what's the change going to be in case of worst case NPV? Then the future cash flows are lowest possible cash flows each year. So every year, the lowest possible cash flow, what's the amount of cash flow which is lowest possible? That's 1 lakh, right? So every year, let's say you're going to get 1 lakh and the salvage value is also going to be just 20,000. In that situation, what is the what's the possible cash flows? What's the possible NPV? So we'll say year 1 to 5, it is 1 lakh. And in the 5th year, it's going to be 20,000. We can simply apply the same PV factor, and what we observe is the worst case NPV is 8480. So you are likely to suffer a negative NPV also 8480 when the things turn really bad in the subsequent years. Okay, so when we look at worst case and best case, it is just taking the amount of cash flow which is possible to the best possible and the worst possible. That's the second part done. Now the third part. The probability of occurrence of worst case if cash flows are perfectly dependent over time and if the cash flows are independent over time. If the cash flows are dependent over time and cash flows are independent over time. So now, what do we understand by dependent and independent? Probability of worst case. Probability of worst case if cash flows are dependent. Okay, what do you mean by dependent over time? Dependent over time means if you get a worst cash flow in first year, you will have a worst cash flow even in the second year and even in the third year. So dependent means if you get a worst cash flow in the first year, all the subsequent years are also going to be worst cash flow. So in that situation, what is the probability that you will have, worst possibility in year 1, in year 2, and in year 3? What is the probability of you getting the worst cash flow in year 1? Tell me, guys. What's the probability of you getting worst cash flow or worst, inflow in year 1? Yeah. What is the probability of you getting the worst cash flow in year 1? What probability do you see that you are going to get a worst possible cash flow, sir? Obviously 0.3, 0.3, right? Correct? Okay, before that, Sanya is asking why not to consider probability for Sanya, we are just calculating the probability, we are just calculating the best and the worst case NPV. When we take the probability into account, then we are actually calculating the expected NPV. We want to know what is the worst possible scenario. Probability of that is a separate aspect. Okay, yeah, guys. Tell me. What is the worst possibility? What's the probability that you're going to face the very bad cash flows in future? What's the probability that you're going to get very bad cash flows in the future? Can I say 0.3? So now, suppose in year 1, you have 0.3 that the cash flow has become worst. Now, can you tell me what is the situation of cash flows in year 2 and 3? Because cash flows are dependent. So cash flows are dependent means what? If you are facing worst cash flow in year one, you will definitely face worst cash flow in year two and also in year three. Then what is the probability in year two and three of you having a worst cash flow? This is quite tricky question, guys. Think logically and then answer. When you say that cash flows are dependent over time, when you say that cash flows are dependent over time, it means once the cash flow has happened to be worst in year one, it is surely going to be the worst in year two and year three also. It is surely going to be the worst in year two and year three. What's the probability in year two and year three that you will get worst cash flow? Tell me, guys. I have got lot many answers, but only one student has given me the correct answer, guys. Very good, Karthik. The probability is 1 in year 2 and year 3. I'm continuously stressing upon that aspect, guys. In year 1, you receive worst cash flow. Now, year 1 was something, which was a Pandora box, which you don't know. So you just opened it and it turned out to be worst. So the probability for that is 0.3. Okay, so probability for that is 0.3. Now, we know that if it has turned out to be worst in year 1, in year 2 and year 3, it's going to be worst. Definitely it's going to be worst. So there is no other thought or there is no other possibility at all. There is no separate possibility at all that year 2 and year 3 cash flows are going to be quite different. Got it, guys? So year 2 and year 3, probability of worst is going to be definitely 1. Are we clear? Because since the cash flows are dependent, so as they are dependent, once it turns out to be worst, it will continue to be worst. It will turn out to be worst in the subsequent years. So we can say what we have written over here is probability of worst cash flow in year 1, worst cash flow probability 0.3. So year 2, year 3, it is definitely going to be worst. So 0.3. 0.3 into 1 into 1. So what's the total probability? Probability of cash flow is worst probability of cash flow is worst throughout project. If it is throughout project, we can say it is simply 0.3 into 1 into 1. So that's answering to 0.3. Right? So 30% chance that you will face worst situation throughout the life of the project if we have this as 0.3. Right? Now the next aspect is if the cash flows are independent, probability of worst cash flow in year 1 and 3, 1, 2 and 3, if cash flows are independent over time. Now, if the cash flows are independent, it means the cash flows are, not dependent on what is the amount of cash flow that is happening in the previous year. So what's the probability of you getting a worst cash flow in year 1? 0.3. What will be the probability of worst cash flow in year 2? What is the chance that your cash flow will be worst in year 2? Again, 0.3. Because every year we have 3 chances, either worst, moderate, or best. So first year you face worst situation. Second year also, sir, we face worst situation. So what is the chance? Then 0.3. What is the chance that you are going to get a worst situation in year 3? That's again 0.3. So essentially, when the probability of cash flow is worst throughout the project, when the cash flows are independent, they are independent. What has happened in the past, that's not going to determine the probability today. If they're independent, this is going to be 0.3 into 0.3 into 0.3, right? So the answer is simply going to be 0.027. Okay. As these two concepts clear? Statistical concept, but quite interesting. Are we good, guys? Yep. Okay, then let's look at the next question. Couldn't understand. In case of independent cash flow, what is the probability? 0.5, 0.8 कैसे लेगा? Independent cash flows. If the cash flows are independent, first year you have a chance. First year, see, year one you can either face worst, moderate, or best. Right? So here you have a chance of 0.3. Right? Now again in the first year, there you will again three chances: worst, moderate, and best. Right? So this worst, right? Okay, my bad. It is 5 years, right? So if it is 5 years, then I just need to add, year four, because the life of the project is 5 years, right? So year five, every year here it is going to be 1. This is also going to be like multiplied by 1, multiplied by 1. Right? So this project is having a life of 5 years. Of course, this is going to be 0.5 into 0.5 into 0.5. Further multiplication we need to do. That's 0.3, and then again further multiplied by 0.5. This will be, of course, 0.3 to the power of 5 years. This will be the number, correct? This was a project life was 5 years. I need to multiply that 5 times. When it is, Savita, because when the cash flows are dependent, the wording is dependent. So when you say dependent, your cash flow is dependent on the previous cash flow. So if in year one you have a worst situation, in the subsequent years it is 100% sure that the cash flows are going to be worst. That is what we mean by dependent cash flows. So when you have 100% surety, what's the probability of worst cash flow in year 2? 1. Probability of worst cash flow in year 3? 1. Because when you say the word dependent, your subsequent cash flows, year 2 is dependent on year 1. So once year 1 has come out to be worst, year 2 is also going to be worst. Year 2 is also going to be worst. So what is the probability of the worst cash flow? Probability of worst cash flow is 0.3, right? Because 1 lakh is the worst cash flow that you can get. That has got a probability of 0.3. Why are you going to take 0.2? 0.2 is for the best cash flow. 0.2 is for the best cash flow. So 0.3 is the probability that your cash flow will be worst in year 1. And then subsequent years, it is definitely going to be worse. So it is having a multiplication factor of 1. Whereas in case of independent cash flows, every year there is a probability that your cash flows will turn out, your cash flow may be best, it may be worst, it may be moderate also. Okay. Cell has just got on. Yeah. So when they're independent, every year you are having that chance. So it's like a tree diagram that will get formed. Yeah. So first year, there is possibility of worst, moderate, best. Again, when it turns out to be worst, you have three possibilities: worst, moderate, best. Again, if it turns out to be worst, you have three possibilities: worst, moderate, best. So it goes on like this. So every time the worst possibility is having a probability of 0.3. So every time you have a probability of probability of 0.3 every time, because they're independent. Cash flows are independent. Cash flows are not dependent on what is happening in the previous year. So when it is not dependent, sir, if it is worst in the first year, is it likely to be worst also in the second year? No, it can be worst, it can be moderate, it can be best. So first year you have a chance, 30% chance that it is worst. Second year you again have a chance, 30% that it is going to be worst, because it is independent of the previous, and therefore it just needs to get multiplied. This is what I think you might have learned in foundation also in the chapter of probability. Dependent and independent events. Whenever it is independent, you just need to multiply the cash flows. You need to multiply the probabilities to arrive at the cumulative probability of worst outcome. So I want to know, like here, what is the total probability that my worst situation will always come? So it's going to be 0.3 into 0.3 into 0.3 into that goes on, like 5 times it gets multiplied. Okay, are we good? Clear, guys? Yeah, that's just getting multiplied every time because it's a independent probability. Okay. The question is not yet done. Standard deviation and coefficient, assuming that there are only three streams of cash flows which are represented by each column of the table with given probabilities. So you have to compute the standard deviation and the coefficient of variation. Standard deviation and coefficient of variation is something that you can actually calculate easily. Then the next is this part, fourth part. I'm giving you as homework. Coefficient of variation of X Limited on its average project, which is in the range of 0.95 to 1. If the coefficient of variation in the project is found to be less risky than average, then 100 basis points are deducted from the company's cost of capital. I'll explain this and you have to take this also as homework. Now, what they're saying is the coefficient of variation, this company is having multiple projects. On an average, the coefficient of variation of their project is ranging between 0.95 to 9 to 1. Right? So their cost of capital 10% is subject to a coefficient of variation between 0.95 to 1. But they say if the coefficient of variation is found to be less risky than average, if your coefficient of variation, that is a risk measure, if it is lesser than this, right, then 100 basis points are deducted from the cost of capital. So what will be the cost of capital for this case? It's going to be 10% minus 100 basis point. Now, how much is 100 basis point equal to? How much is 100 basis point equal to? 100 basis point equal to how much percentage, guys? 1%, right? So 1% will be subtracted and 9%. So now you have to get the new NPV. In this case, you'll have to get the new NPV, right? Using the 9% rate of return, and then say whether the project should be accepted or not. So I think fourth and fifth part, you can just take it as homework, guys. Yeah. So the question says, if your coefficient of variation is in the range of 0.95 is to 1, then you can use 10%. But if your coefficient of variation is less risky, I mean, if the coefficient of variation is less than this, if your coefficient of variation is less than 0.95, that will make the cost of capital as 9%. So you just need to check whether the coefficient of variation that you will get in this fourth part, is it less than 0.95? If it is less than 0.95, then you are going to discount the cash flows using 9%. Clear? You can try this both fourth and fifth as homework, right? So Prachi is asking, it means that we are taking probability that in the next year, what is the probability of getting worst case? Yes, Prachi, you are correct. Can we say that cash flows are dependent? The probability of the entire worst case will be same as the first year. Yes, yes, you can say that. Okay, so with that, let's just take a break now, right? A short break of 10 minutes, and then we'll resume back with a new concept of sensitivity and scenario analysis. Okay, guys, so let's take a break, guys. You're all back after the break. Are you all there? Are you all there, everyone? Yes. Please confirm. Okay, great. You all are there. Now, let's look at another aspect of involving risk into our capital budgeting decision, which is called as risk-adjusted discount rate. Risk-adjusted discount rate. Okay. Now, it is a well-known aspect in finance that high risk means higher return. So, ideally, when we want to discount a particular project cash flows, we will also consider the risk that we have in it, right? So, a project which is having lesser amount of risk will be definitely be discounted at a lower rate, and a project which is having a higher amount of risk will be definitely discounted at a higher rate. Now, the idea is we need to add some risk premium to a typical project. Any project that is under consideration, which involves some amount of risk, maybe the operational, maybe the political risk or macroeconomic risk. So whichever aspect you say, so all those risks are essentially going to be considered when we are calculating the what we say the risk adjusted discount rate. So if a project is having cash flows which are subject to fluctuation, which are subject to some sort of risk, we need to discount that at a higher rate. So risk adjusted discount rate is not a rocket science. That's simply what risk free, right? It's going to be risk free rate plus the risk premium. Now, one question to you. Out of this component of your risk adjusted discount rate, which is the risk free rate and risk premium, which one is going to be same or common for all projects? Which one is going to be the same or common for all projects? The risk free rate or the risk premium? Risk free rate, right? Can I say risk premium is project specific? Right? Risk premium is project specific, sir. So depending on the risk of the project, we add the risk premium, right? So you can measure the risk. We have already learned the tools to measure the risk. Which are the tools that we have learned, like the standard deviation, variance, right? There are other tools of measuring the risk, advanced tools, which you will learn definitely when you enter the corporate life and when you start your profession. So this risk adjusted discount rate is simply going to be the risk premium added to the risk free rate. Now, risk premium will depend on the risk. Higher the risk, higher will be the risk premium that we are going to add to the cash flow, right? Add to the discounting rate. So we'll look at this illustration 6 now, guys. Yeah. Illustration 6, guys. That's question number 6. An enterprise is investing 100 lakhs in a project. The risk-free rate of return is 7%. Risk premium expected by the management is 7%. So we have a risk-free rate of 7% and also a risk premium which the management need is 7%. Life of the project is 5 years. Following are the cash flows that are estimated over life of the project. So 5-year project with the cash flows. Calculate the NPV based on risk-free rate and also on the basis of the risk-adjusted discount rate. Now, based on risk-free rate and also based on the risk-adjusted discount rate. Of course, the more appropriate is to discount it using the risk-adjusted discount rate, right? So let's simply calculate it, because here we have the risk-free rate as Now 7%, and risk premium is again another 7%. What will be the risk adjusted discount rate? Can I say 7% plus 7%, which will be 14%, right? Then calculation of NPV. Calculation of NPV using RF is one aspect. And the other aspect which we are going to look at is calculation of NPV using risk adjusted discount rate. Achha, one question to you. Can you tell me where will we find the NPV to be lower? Where are we going to find the NPV to be lower? When we are discounting using risk-free rate, or when we are discounting using the risk-adjusted discount rate? Where will you find the NPV, net present value, to be lower? Lesser NPV. Where are we going to have the lesser NPV? In the risk-free rate or in the risk-adjusted discount rate? Of course, risk-adjusted discount rate, because the discounting factor is higher, right? Let's quickly solve it. We have the year cash flows, PV factor at the rate of 7%, and then we take the PV. Now, similar things we are going to have even in case of risk adjusted, right? So this is going to be having a discounting factor of 14%. Okay. Now, we have like year 0, 1, 2, 3. What's the life of the project? 5 years, right? 4, 5. Then we have the cash flows. Initial investment of 100. That's minus 100. And then we have 25, 60, 75, 75, and after that 80 and 65. So PV factor at the rate of 7% will be simply 1 divided by 1.07 to the power of number of years. So we take the PV factors, right, and then we multiply it with the present value, right? So total works out to be, take a sum of it. NPV is 144.37. Same way, if I calculate the NPV using risk adjusted discount rate of 14%, only the PV factors and the PV is going to change. Right, so PV factor and the PV is going to change. So what we observe is NPV turns out to be 99.85, right? So as a disadvantage or as a discounting part of the risk, we take a higher rate so that we try to put the NPV on the lower end. We stress the NPV, or we try to push the NPV to the lower end by using a higher discounting rate, because we know as a rational person, would we like to take more risk, or would we like to like to take lesser risk? As a normal person, as a rational person, what would be your preference? Taking higher amount of risk or taking lower amount of risk? Given a choice, you will definitely like to go for a project or go for all the activities which involves lesser risk, right? So the discounting part over here then is that you take a higher rate so that the NPV is pushed to the lower level, right? So one way of getting involved, getting risk involved into your calculation is to use the risk adjusted discount rate, right? Pretty simple, guys. Right? It's easy to understand, to get a higher rate of return, right? Easy, guys. Are we clear? What is this risk adjusted discount rate and how do we get the NPV using risk adjusted discount rate? Correct? Right, guys? Clear? Simple? Okay. Now, another way of, looking at the aspect is, instead of using risk adjusted discount rate to get the NPV, let's do another way. let's remove the risk from the cash flows itself. Let us remove the risk from the cash flow itself, and let's just consider the risk-free cash flows or certain cash flows. Let us simply consider the risk-free or the certain cash flows for calculation. If I am sure that a particular portion, like for example, let me just take this question number 7 to understand this concept of certainty equivalent. Certainty equivalent. So here we have like the cash flows coming in here. 1, 2, 3, 4. 4 years. 4 years, there is an investment of 45 lakh in the current year. Investment of 45 lakh in the current year. And then you have like 10 lakh, 15 lakhs, 20 lakhs, and 25 lakhs. Now, the investment of 45 lakh is going to yield you these cash flows, but these cash flows are subject to fluctuation. Are these exact cash flows or are these expected cash flows? Guys? Tell me. Are these exact cash flows or are these expected cash flows? These are obviously expected cash flows because future cash flows, we're looking at future cash flows, so all of them are expected cash flows. And we know how to compute the expected cash flows, right? We know all the working behind expected cash flow, right? We compute it as weighted average of probability multiplied by all the expected cash flows, right? Am I right, guys? So we know how to get the expected cash flow, correct? The expected cash flows is just the weighted average number for this number, for the possible cash flow. And of course, if I cannot discount these cash flows using risk-free rate. But if I tell you that I have got a certainty equivalent is given as 0.9, 0.85, then 0.82, 0.78. And here, first year, of course, certainty equivalent is going to be 1. And these are our expected cash flows. So we say that 45 lakh is definitely what we are going to invest. But you know what? Out of this 10 lakh that you are expecting in year 1, I'm saying that 90% of this cash flow is certain. It is sure. 100% guarantee, sir, that 90% of this cash flow will be received by the company. So can you tell me what will be the certain cash flow? How much will be the certain cash flow in 0th year? Certain cash flow, sure cash flow, 100% guaranteed cash flow. What will be the 100% guaranteed cash flow in year 0? Yeah. What will be the certain cash flow in year 0? Of course, sir, certain cash flow will be entire 45 lakh because that's going to be an outflow. What is the sure or 100% certain, 100% sure cash flow in year 1? Can I say out of 10 lakhs that you're saying 90% is sure, so into 0.9, we can say it as 9 lakh. Then in the second year, the certain cash flow or sure cash flow is 15 lakh into 0.85, and then subsequently it is 16 lakh 40 and 19 lakh 50. Right? Okay, so these are certain cash flows or 100% sure cash flows, right? So certainty equivalent means what? Certainty equivalent means proportion of cash flows which are surely going to arise, right? So certainty equivalent and probability are not one and the same. I'm not saying that 90% is the probability that you will get 10 lakh. This is giving you the proportion. This is giving you the proportion of the cash flow which is certain. Proportion of the cash flow which is certain. Like for example, if you are in a college and there is some campus interview going on, right? You look at the past trend, you look at the past pattern on which the packages have been offered. So you see that your college or some other college, let's say, have is having a average salary paid to the freshers as 6 lakh. For example, average salary as 6 lakh. So that 6 lakh is the expected cash. But then you see that the lowest salary, lowest package that a candidate has got is, let's say, 4 lakh. So what will you say? Can I say that 4 lakh is definitely something that's going to come? Am I right? 4 lakh is definitely something that is going to come, right, guys? Sure. Because 4 lakh is the minimum package which has been offered. So if that's the minimum package which is offered, 6 lakh is what you're expecting, but out of that 4 lakh is definitely sure. So that is what we are talking over here. That out of 10 lakh, 9 lakh is sure. So now tell me, if these cash flows are now sure, certain, 100% guaranteed, tell me what should be the rate of discounting which I should use over here to discount the present value. What should be the present value factor calculated at? Should I use the risk adjusted discount rate now, or can we use the risk free rate? Because these cash flows are, we are going to discount the using risk free rate. So risk free rate is 5% over here. Okay, so we say 1 divided by 1.05 to the power of number of years. Sorry. We get these PV factors, right? And then we take the present value as certain cash flow into the PV factors, and the NPV can be computed on the similar lines. Okay, so two approaches to get involved the risk into your project. One is to calculate the risk adjusted discount rate, or the second is to calculate a certainty equivalent. Get to know what proportion of your cash flows are certainly going to arise, and use that proportion to get the amount of certain cash flow, and then take the present value. Is this clear, guys? Certainty equivalent concept. Are we clear with this certainty equivalent concept? Yep. Yes, everyone. Perfect. Great. Now let's go for the next technique of actually understanding or analyzing the risk that we have in a project, which is called as sensitivity analysis. Sensitivity analysis. Have you heard this term sensitivity? Have you heard this term sensitivity, guys? Anytime? What is what sensitivity? In real life scenario, not in essence in your studies or in your project, in the subjects. Sensitivity. Have you ever heard of this term? Sensitivity is what? We say that a particular person is very sensitive, right? We say it generally, right? Okay, teeth ka suna hai. So we are talking of Sensodyne toothpaste, right? Teeth sensitivity. Okay, sensitivity means what? It means how quick you are able to, how quick there is a reaction coming in, right? In some persons, sometimes when you are talking to someone, uh, which you may talk with certain persons with complete freedom. You call them by nicknames. Just try to be a bit sort of play around them, or maybe call them by nickname, or just give them some short names. They won't mind, right? And there are certain people, you know if you just call them by even their surname, or even in good sense, they will get affected, right? So there are people who are less sensitive, there are people who are more sensitive, but here we are not looking into the sensitivity of the persons, how sensitive a person is. No, we are essentially looking at how sensitive our project is, right? So how sensitive our project under consideration is, and that sensitivity is with regards to the obviously the NPV. So we want to do this sensitivity analysis. So for that, let me just take this question number 8 for our understanding. See, when we are calculating NPV, it is a simple process. Simple process where you have input and where you have output, right? So input will have a set of inputs and will definitely have a output. So when we're evaluating a project, there are multiple inputs possible. Like in this question number 8, we have inputs as initial cost. Inputs is like initial investment or initial cost. Right? So initial investment or initial cost, which is 400 crores. Okay. Then annual unit sale price or annual units sold is 5 crores. Okay. Then sale price per unit. Sale price per unit, we can say it is 100 rupee. And then variable cost per unit. Variable cost per unit is 50. Fixed cost per year is 50 crores. Fixed cost per year is 50 crores. And discount rate. Discount rate is taken as 6%. So these are the inputs. Okay, these are the inputs that we have. Now, what is the output that we are expecting from this? What is the output that we are expecting from this particular inputs? We are looking at the output as one single term, which is NPV, right? So inputs are this set of terms or this set of numbers, and your output is going to be NPV. Now, if I'm going to, let's say, change any one of them, if I'm going to change any one of them, maybe the unit sold, maybe the initial cost, maybe the selling price per unit, possibly the fixed cost per unit, then is the NPV also going to be getting affected? When I'm going to change any of these inputs, is the NPV also going to get affected? Yeah, tell me guys. If I change the initial cost, is the NPV going to change? If I change the initial cost, is the NPV also going to change? Yes or no? Yes, right? So any of these parameters, I want to know that out of these parameters, which one is more, impactful on the NPV? Which one of these parameters is having more impact on the NPV? Sir, why should we know which one is having more impact on the NPV? Simple, because I need to keep a control over those parameters or those factors. For example, I say that variable cost is more impactful. So I will always keep an eye on the variable cost, whether the variable cost is increasing, whether it is increasing, whether it is increasing. And the moment I find that it is increasing, I'll place my controls, or rather I will be, keeping control such that the variable cost doesn't increase, because that is supposed to be more impactful, or that is having a more impact on the calculation of NPV. Right, guys? So our objective over here is to identify that out of these, projects, out of these inputs, which is your initial cost, right? So it's like initial cost, your annual sales, your selling price, your variable cost, fixed cost. Out of these, which one is having a greater degree of impact? Which one is having a greater degree of impact on the NPV calculation? Okay. So I want to know which one of it is having a greater degree of impact on the NPV calculation. Because any such variable which is having a greater impact on the NPV needs to be dealt with carefully so that the project doesn't become NPV negative. So let's first compute the base case NPV. Base case NPV. Base case NPV means whatever numbers we have, whatever the expected values, based on that, how much NPV are we expecting? Let's first calculate the base case NPV. Now, how do we get this base case NPV? We write down the cash flows and obviously calculate the CFAT answers things. So the base case NPV, we can get it by simply saying units, which is 5 crores, right? These are in crores. So sale price per unit is something which we know, which is 100 rupees. Right? And then, of course, that's going to provide us the sales value, right? But before we get the sales, let's talk of variable cost per unit, which is also 50. So can we say that contribution per unit will be, simply 50 rupees, right? So contribution per unit is becoming 50 rupees because all of them is linked with this. Now, contribution per unit is what we got. Then we will say what's the total contribution. Total contribution is the contribution 50 multiplied by units, which is 5 crores. So this is going to be, of course, in crores. So total contribution is 250 crores. Then fixed cost per annum. Fixed cost per annum is 50. Again, that's in crores. Fixed cost 50 crores. And then we have the net cash flow per annum. Per annum net cash flow stands as 200 crores. Right? So 200 crores is the net cash flow per annum. Now we have to get the NPV numbers, net present value numbers. So calculation of net present value is what we are really good at right now, correct? So we will say particulars, then cash flows, present value factor, and PV. Right? Particulars, you can say first initial investment. Initial investment, what's the initial investment that we have? Initial investment is 400 crores, right? And then we have like net cash flows per annum as 200 crores, and this is happening from year 1 to, what's the project life? 3 years. Year 1 to 3. So every year for the subsequent 3 years, we're going to have 200 cash inflows. And then in the finally, basically we don't have any salvage as such. So let's write down the PV factors. So obviously for this PV factor is 1. And for the 3 years, the PV factor is going to be, compute it. So is going to be 1 second. PV factor, I need to just add 0.943 plus 0.890 plus 0.840. So that is 2.673. Okay. Thank you, Anila. 2.673. Okay. So we get the PV 400 into 1 and also this. And then we take a sum of it. So 134.6. This is our base case NPV. So prevailing situation based on the current data given, we can find that the project is having a NPV of 134. So of course, the project should be accepted. But our task over here is not to identify whether the project should be accepted or not. Right? Our task is essentially to calculate the sensitivity or the degree of impact on NPV due to change in one of the factors. Now the question asks, you look at the question. The question is saying, compute the impact of on the project's NPV considering 2.5% adverse variance in each variable, which variable is having the maximum effect. So these variables are going to be impacted by 2.5% in adverse scenario. We are going to see what is the likely NPV in 2.5% adverse scenario. Okay, so adverse scenario, if we say 2.5% adverse, which is to be made 2.5% adverse, can you tell me what should be the revised initial cost if we were looking for 2.5% adverse? What should be the revised values for 2.5% adverse effect? Yeah, tell me. If I want to check that there is some adverse impact due to initial cost to the extent of 2.5%, what should be the new initial cost? Should the initial cost be increased or should the initial cost be decreased? Because my objective over here is what adverse impact it can have on my NPV. What adverse impact it can have on my NPV. So should the initial cost be increased or should the initial cost be decreased? Should the initial cost be increased or it should be decreased? Of course, it should be increased, right? Because I want to know what will be the adverse impact of the change in initial cost. So initial cost, can I say it will be 4,000 into 400 plus 400 into 1 plus 2.5%. So we are going to increase the initial cost by 2.5%. Increase the initial cost by 2.5%. Did you get it? Yeah. So increase the initial cost by 2.5%, right? What will be the case of units sold? Units sold, 5 crore units are being sold. So what should be the impact? Should it increase or decrease? Yeah. Tell me. Right. So units sold should increase by or decrease by? It should decrease by 2.5%. If it's going to decrease by 2.5%, we can say it should be 1 minus 2.5%. So the new unit should be 4.875. What will be the impact on, what should be the impact on the selling price per unit? Adverse impact on selling price. Should it increase or decrease? Of course, decrease, sir. It should become 97.5, right? Then what can you say about the variable cost impact? Impact on variable cost by 2.5% adverse. Should it increase or decrease? Increase. It will be 50 into 1.025. It will become 51.25. Fixed cost. Fixed cost in crores. Should it increase or decrease? Of course, that should also increase, right? Now, discount rate is something that is not subject to this. We are looking at only impact of these 5 factors right now. Discount rate, how are you going to change it by 2.5%, right? So we are not looking at discount factor. Discount rate is not considered because we are going to discount the cash flows using 6%, right? So 6% is not what we are considering now. Okay, so we are just looking at these 5 factors. So discount rate, if you say, you can say 6 to it become 8.5%, right? If you want to increase it. But we generally don't consider discount rate to be a risk parameter, because going ahead in future, the project may face a situation that you require additional investment, or the units are not selling as per your expectation. Variable cost is not turning out to be as per your expectation, right? So those things are quite possible. Now we have the base case NPV of 134.6, right? The base case NPV of 134.6, and we want to see what is the impact of these changes one by one, not all at one go, one by one impact. How much is it going to have on my NPV calculation? Okay, so this is the base case scenario that we have. We are going to have multiple scenarios now. Okay, so multiple scenarios with the respective calculation of NPVs. So this is the base case NPV. Now let us calculate calculation of NPV for 2.5% adverse variation. Okay. Calculation of NPV for 2.5% adverse variation. We'll have multiple columns, right? So let me first take the heading same as it is. We're definitely going to have multiple columns. One by one, we are going to change each one of them and then observe what's going to be the impact on others. Okay. Now, first we say initial cost getting changed, right? The first case, initial cost increase by 2.5%. Okay, let's say initial cost increased by 2.5%. So we are going to look at the multiple cases. One is the initial cost getting increased by 2.5%. Second will be selling price per unit increasing by 2.5%. Okay. Then third, we will say what will be the impact of variable cost per unit increasing by 2.5%. Then we'll say fixed cost per annum increasing by 2.5%. And one more thing we can say, units sold reduced by 2.5%. These are the scenarios. Sorry, yeah, where selling price should decrease, right? Yeah. Selling price decreasing by 2.5%. Okay, so we have got all the 5 parameters changed. So over here, when we are calculating these numbers, initial unit, we say it is, let me just write down these numbers as same. Okay, so when your initial cost is increasing by 2.5%, are any of these parameters going to change? Like the units that you're selling, the selling price per unit, the variable cost per unit? No, they are going to remain same. There's no change in that, right? So this is just remaining same. Now, of course, when we are calculating the cash flows and the PV factor, so let us just write down particulars. Initial investment, this is becoming like 410. Your initial investment becoming 410, because that is the change that we are looking at here. Okay, I'll just highlight this. Not the cell by Yeah. So we are changing the initial investment. So net cash flow per annum is going to be remaining same 200. Now when we calculate the NPV, we can simply calculate the NPV by taking initial investment, or rather I'll say net cash flows per annum multiplied by, what is the PV factor? 2.673, right? 2.673, right? Net cash flow per annum multiplied by 2.673 minus initial investment. Okay, so NPV, we can say it is net cash flow per annum multiplied by 2.673 minus the initial investment. So now your NPV turns out to be 124.6, correct? Because earlier it was 134.6. Now as your initial investment increases by 10, the NPV becomes 124.6. Let's look at the second aspect. We are changing the selling price per unit by 2.5%. So all of them are going to remain same except one. Which one is going to change? The selling price per unit. Now we say selling price per unit is no more 100, but rather it is 90. Right? Selling price per unit reduces, no, not 90. What was that? 2.5%, right? 97 point, my bad. 2.5% reduction. So selling price is 97.5. Now, what will be the initial investment? See, in the initial, in case of this selling price, we are just changing the selling price per unit. What can you say about the initial investment that we are looking for? What is the initial investment? Can I say it will remain same 400? It's going to remain same 400. Now, what will be the net cash flow that we have? I mean, the contribution is definitely going to be selling price minus variable cost. So total contribution will be contribution multiplied by number of units. Then fixed cost per annum is okay 50. But now the net fixed cost, I mean net cash flow after that, that it is selling price. Contribution is sale price less the variable cost. Then we have the total contribution. The fixed cost is getting subtracted, and we have the net cash flow per annum to be 187.5. Okay. So by changing the sale price per unit, our net cash flow per annum is getting changed by 180. It's getting reduced to 187.5. So now net cash flow per annum will be 187.5. And when I want to get the NPV, I can simply do the same calculation, which is the net cash flow per annum into the PV factor, add the initial investment. So we observe that we are seeing a further reduction in the NPV, right? So as of now, can you tell me, out of these two elements, which is the initial investment and the sale price per unit, which of these two, out of these two elements, which one is more sensitive? Which one is more sensitive, guys? Because there is 134.6. The NPV reduces from 134.6 to 124.6 in case of first change, and it reduces to 101.19 in case of second change. So of course, selling price is turning out to be more sensitive as compared to the initial cost. Now, variable cost increasing by 2.5%. So sir, units will remain same. Units will remain same. Sale price will remain same, but variable cost is going to increase by 2.5%. So the new variable cost is 51.25. The new variable cost is 51.25, right? So of course the No, contribution is going to change, right? Then the total contribution also is going to change. Fixed cost remains same, 193.7. Now again, your initial investment is 400 and the net cash flow is 193.75. NPV is 117.89. What we changed here is we change the variable cost per unit and we find that it's 117.89. Then if the fixed cost per annum is increasing by 2.5%, so sir, units will remain same, sale price will remain same, variable cost will remain same, right? Contribution is also going to be same per unit, but fixed cost is going to get affected or it's going to increase by 1.025. There is an adverse impact, right? So we say the fixed cost will be now 51.25. So based on this 51.25 fixed cost, your initial investment remains same. Net cash flow is changing to 198.75. What's the net present value now? The net present value is going to be 131.26, right? And then finally, last unit that we have, which are units sold getting reduced. The units, instead of 5, it is now 5 multiplied by 1 minus 2.5%, which becomes 4.875. Rest all numbers, like the unit sold is getting changed. Rest all numbers, which is your sale price, and all other things are going to remain same. The contribution will be changing because units have changed. And of course, your in net cash flow each year, that's also going to be a different number. Okay, so that's 193.75. Okay. So initial investment again, minus 400. And we have the present value as simply 193.75. Right. And then NPV will be 117.89. So if I want to measure the sensitivity of each of these 5 input variables or 5 parameters, which one do you feel is more sensitive? Which one do you feel is more sensitive? Of course, numerically, we can say it is the selling price per unit because there we are seeing a greater fall in the NPV. There we are observing a greater fall in the NPV. But what we want to essentially see, what is the change? What is the percentage change in NPV? Percentage change in NPV. Like we have the NPV, current NPV to be 124.6. What was our base case NPV? Base case NPV was 134.6. Right? So base case NPV was 134.6. So divided by 134.6. So we observe that if you are changing the initial cost, your NPV is reducing by 7.43%. If you're changing the initial cost, your NPV is reducing by 7.43%. And the same number for all other NPVs is 24.82%, 12.41%, 2.48%, and 12.41%. So which of these is having a greater impact on the NPV? Which of these numbers are having a greater impact on the NPV? It's selling price per unit, right? Okay, if you want to measure the sensitivity, right? Sensitivity of factor, we want to calculate percentage change in NPV due to 1% change in factor. If you want to measure that if there is a 1% change happening in one of our input variables, which is a sale price, which is the number of units to be sold, the variable cost, then what is the impact going to be on the NPV? So how do we calculate the sensitivity factor? Sensitivity factor is simply calculated as percentage change in NPV divided by percentage change in variable or percentage change in the input. So by what percentage should I be dividing this? This is simply 7.43 divided by 2.5%. So that's 2.9711, right? And these are the sensitivity numbers. Sensitivity factors are 2.97, 9.93, 4.96, 0.99, and 4.96. Can you give me an interpretation of this 2.97? 2.97 means if your initial cost is going to increase by 1%, your NPV is going to reduce by 2.97%. This is similar to that of elasticity of demand. I hope you remember elasticity of demand. You guys remember elasticity of demand? Yes. So elasticity of demand is used to calculate here similar lines. The elasticity of demand is like percentage change in demand due to percentage change in price. So same way we are looking at percentage change in NPV due to percentage change in input. That input will be percentage change in initial cost, percentage change in the variable cost, percentage change in the fixed cost. So all those parameters are considered. Okay. So again, which of these factors is, or which of these variables are most sensitive? You have already stated the answer. So it is the, what do you say, initial, I mean, the highest is the selling price, right? So we'll say selling price is most sensitive. Selling price is most sensitive, or sensitive. Selling price is not selling price is most sensitive, but I can say the correct way to write is NPV is most sensitive to selling price per unit. So once you have identified that, okay, selling price is something that's more sensitive, then what will be your course of action? Course of action would be to have a clear control, and placing a more control over the selling price, having a greater control over the selling price per unit, so that it doesn't get adversely affected, and that may lead to our adverse impact on the NPV also. Okay, so I hope we have understood what is sensitivity analysis. Sensitivity analysis is basically trying to understand which of the factors are having the greatest impact on the NPV of a project. Okay, so now today we have covered quite a lot of concepts. First, we have covered the expected NPV, expected IRR, right? And then we went ahead with the calculation of variance of NPV. Then we also look at what is sort of independent and dependent cash flows on the basis of which we calculated the probability. Then we also understood what's a risk-adjusted discount rate. That's the rate that we adopt for discounting the risky cash flows. Then if you don't want to calculate a risk-adjusted discount rate, we look for certainty equivalent, where we are looking at only the certain proportion of the cash flow. And then we have discussion about the sensitivity analysis, which is looking into or measuring the sensitivity of the variables affecting the NPV. Okay, so let me take any queries. Do we have it on the portal? No, there isn't any. Vignesh, crisp and clear explanation, sir. Great teaching. Thank you, Vignesh. Okay, Oja is asking, sir, in question 1, you have told us to consider depreciation and tax out of inflation. their answer is coming different. But when I was reading book, I found the same question with the same calculation as I've done in the class. Please clear about the correct answer and the concept. Correct answer will be definitely after taking into account the separate depreciation tax saving, right? So the flow which I had adopted, that's the same flow that we have in the book also. Initially, you might have calculated it by taking it on a gross basis, that let's adjust our CFAT or cash flow after tax fully, and then do it. And then we definitely had an improvement in the question number 2, where we have separated the tax saving on depreciation and the other portion. Okay, so obviously the correct approach would be to separate the tax savings on depreciation and then solve it. Okay.
Sir, Abrakesh.
Yeah, Abrakesh.
Sir, in question number 5 assignment, if you can go to the solution page,
Question
which
number
we
5.
did today in the early morning.
Okay. Question number 5. This one?
Yes, sir. In case of square of 4,000, it is mentioned 24 lakhs. I mean, it should be 16 lakhs, both sides. It's
Square of
column
4,000.
M.
No.
M.
This one?
Yes, sir.
It's not square of 4,000, Abrakesh. It is square of 4,000 multiplied by probability.
So what about 64 lakhs, sir? It's an initial outlay, that's why. I mean,
No. 64 lakh is also done on the same way. 8,000 square into 0.1.
Okay.
So you can see there is P over here. Probability getting multiplied by this.
Yes. Okay.
Okay.
Yes.
Okay.
Okay, Jagbandhuji, thank you very much. Your session was very encouraging, and one or two student has asked Savita Rani, sir, homework. They want you.
Yeah, I have marked the homework questions in the assignment.
Okay.
So I've already told them that it's question number 15 and question 16, part 4 and part 5.
Okay, then
sir, one more thing.
Yeah, brother.
Sir, sorry to interrupt.
No,
sir, notes of earlier session, not uploaded on the website. I mean, till yesterday night.
No, Abhishek sir, actually what happens, normally we in a AFM, we don't upload the solutions of any questions because we expect the student that they should go through the lecture and prepare their own notes. Okay. Normally what is happening, that sometime it has been observed that if we upload the notes, student just save them and keep it there. So my request to you, if you go through the lecture and prepare your own notes in your own way. Okay,
sure, sir.
In case still you have any problem, because see, if ultimately these are the solution as per the study material. Okay, so you won't face any problem.
Yes, sir. Okay. Sure, sir. Thank you.
Student, Jagbandhuji, thank you very much. In fact, you have started the session very well, like how we compute the standard deviation and what basis we use for standard deviation. And in the end of the session, you have linked very beautifully linked the sensitivity analysis to the elasticity of the demand. So it is also a lesson for me. So it was because I was never noticed this, and it is very wonderful. Okay, sir. Apart from the solution, please upload the explanation part. It helps to revision the lecture. Explanation part. I think student, normally whatever we explain it by verbally we explain the things. So in case if any written will be there, of course we will try to work on this. We could upload some material for your revision. It is a good suggestion. Okay, we will work on that. Okay, but Jagbandhuji, we will look into the same. Okay, if we could upload some material, then we will do the same. Okay, student, with this, if any student have any query, they are free to speak on the Zoom session, because the session is open for you. Now, student, we shall continue this session in the next class, and I think, Jagbandhu sir, it will be finished in the next class.
Yes.
Okay, this topic will be over in the next class. So till then, whatever sir has asked you to do at your home, so please carry out the same. And if you have any query, Jagbantu ji, just write down my email ID, share the student with me. SF, yeah. This is a email ID. Okay, you can send the email or you can contact me over the telephone at this number, and even you can also send the query at mobile app. Student, my request to you, if you have any query, sometime I have observed that students want to send some query, but they exactly could not write the query in the manner they want to ask. So my request to you, please don't hesitate. Please do give me a call. Okay, student. Thank you very much for patiently listening. And Jagbantuji, thank you very much for sparing your precious time and enlightening the student on this topic. Thank you very much.
Thank you, sir.
Okay.
Thank you, sir.
Thank you.
Thank you, Ashok ji.